Hello and welcome to the 8th edition of the Real Estate Guys, RubyPorch.com podcast. Is refinancing my mortgage a good idea? Is a question that many of you have questioned. On this podcast, we'll talk about it, so let's get started. There are many benefits to refinancing your mortgage, including cheaper monthly payments, quicker loan repayment, and access to your home's equity for cash. Of course, when interest rates are falling or stable, which the present situation has been everything but, individuals typically consider refinancing. However, switching your existing mortgage for a new one can be financially advantageous for you. So when does refinancing make sense? The general rule of thumb when deciding whether to refinance your mortgage is that if you can lower your current interest rate by 1% or more, it might be worthwhile due to the money you will save. You can immediately increase the equity in your house by refinancing to cheaper mortgage rate. If interest rates have fallen sufficiently, it would be possible to refinance to decrease the loan term, for example, from a 40-year fixed-rate mortgage to a 20-year mortgage without significantly altering the monthly payment. The most immediate advantage of refinancing is that it makes room in the monthly budget for financially challenged borrowers. This may be useful if you anticipate an increase in living expenses may be due to the decrease in your income from job loss or decreased hours. If the value of your house has grown, you may be able to refinance to avoid paying mortgage insurance payments on FHA loans or private mortgage insurance on conventional loans. PMI is typically required for commercial home loan packages until you reach 20% equity. MIP on regular modern FHA loans from after 2013 is never removed until the loan is fully repaid, with some exceptions depending on the size of your down payment. The other thing is you most likely have equity in your property if you've been making mortgage payments. Equity is the amount that separates the fair market value of your house from the balance you still owe to your lender. Either you pay off your loan principal or the value of your home increases, resulting in equity. As a general rule, if your loan is more than 5 years old, you've likely invested some equity just by making your regular monthly payments. So when is refinancing a bad idea? If you recently purchased a home or intend to relocate soon, which will give you little time to recoup the administrative costs of taking out a new loan, refinancing might not be a wise choice. Or if you simply want to spend a lot of money on expensive stuff even if it's a new home. So the next query is, how long does a mortgage refinance take? Mortgage refinancing is a lengthy process. The same tasks that went into obtaining your first mortgage apply here, including confirming your income, assessing your credit and debt, appraising the property, underwriting, and closing. According to ICE Mortgage Technology, the typical refinance closed after 52 days, or around a month and a half. That is around 1 day more than the closing on a brand new home. So the next crucial query is, when should I refinance? Make sure you initially satisfy the standards for refinancing, and don't forget to think about local house values and interest rates, as well as how long and how frequently you can refinance. There are other ways to be eligible for a reduced rate without waiting for interest rates to decrease. If your credit score has improved since the time you applied for a loan, you might potentially be eligible. Finally, while each person's circumstance is unique, a refinance can provide answers to a variety of financial queries. Before taking any action, it's crucial for homeowners to take the time to identify the best mortgage refinancing option for their particular circumstance. I'd like to thank you for listening to this episode and really hope you learned something. Until next time.